So far, there have been several videos on this channel regarding what happens when you sell a capital asset at a gain. If you haven't seen these videos, you might want to click on the playlist above or on the end screen for a thorough introduction to capital assets and capital gains. But what happens when you sell a capital asset for less than its basis, creating a loss? That's the topic of this video. I'm the Tax Geek, back with more of your taxes, oversimplified. Investors don't always have good fortune when investing. Sometimes they have to sell their investments for less than what was paid for them to meet an urgent financial need. Sometimes investors sell their investments at a loss to put a stop to future losses. This begs the question, can these losses be used to offset other income? The answer, which is so often the case with tax matters, is that it depends. First of all, it depends on the use of the capital asset. In a prior video, we learned that capital assets can have three uses: personal use, business use, and investment use. Losses on the sale of personal use capital assets can never be used to offset other income. Most people own all sorts of capital assets for personal use, the vast majority of which lose value over time. But selling, disposing of, or giving away these assets for less than what you paid for them does not create a tax loss that can be used to offset other income or even other capital gains. If you incur a loss on the sale of a capital asset used in business, these losses can potentially be used to offset other income. However, the mechanics of claiming such losses is quite complex and will be the subject of another video. This video primarily concerns itself with losses incurred when selling investment use capital assets for less than their bases. These losses can be used in a limited way to offset other taxable income. To find out how, let's follow one taxpayer for a couple of years to see how capital gains and losses affect each other. Meet Hilda. This is Hilda's Schedule D for 2021. Notice she has a short-term capital gain of $3,750 and a long-term capital loss of $8,355. Filling out page 2 of the schedule is relatively straightforward for Hilda. On line 16, she combines the totals from lines 7 and 15. This gives her an overall capital loss of $4,585. Since line 16 is a loss, she then skips straight to line 21. Capital losses on investment use assets can be used to offset other income up to $3,000 for all filing statuses except married filing separately, where allowable capital losses are limited to $1,500. Since Hilda is single, she temporarily converts the $4,585 capital loss and the $3,000 allowed loss to positive numbers and puts the lower amount on line 21, in this case $3,000, and converts the result back into a negative number. This number goes on line 7 of her Form 1040 and is subtracted from her other income. So what happens to the remaining $1,585 in losses? Let's fast forward to 2022. This is Hilda's Schedule D for 2022. This year she had no short-term capital gains or losses, she just had a $3,135 long-term capital gain. But before she puts that capital gain on her tax return and calculates her capital gains tax, she needs to fill out this capital loss carryover worksheet. This worksheet is essentially the same calculation I did earlier in step-by-step format. The result of this worksheet is then entered on line 14 of Schedule D, which is then subtracted from her long-term capital gain to arrive at a net gain of $1,550, and that's the figure she enters on line 7 of her Form 1040 and uses to calculate her tax using the Qualified Dividends and Capital Gains worksheet. Now let's suppose Hilda only had a $789 long-term capital gain. Notice the capital loss carryover worksheet remains the same. The same carry-forward loss of $1,585 is subtracted from the $789 gain, reducing it to zero, and the remaining $796 in losses would carry forward to 2023. And finally, let's look at what would happen if Hilda had another $2,450 long-term capital loss for 2022. Here, the result of the capital loss carryover worksheet of $1,585 would be added to her 2022 $2,450 long-term capital loss, giving a total loss of $4,035. She would be able to use $3,000 of that loss on her 2022 return to reduce her taxable income, and then would carry forward the remaining $1,035 loss to 2023. Please note, the capital loss carryover worksheet is not sent with your tax return. Instead, you keep it with your records since you may need it if the return is audited. Also, it is up to you to keep track of these carry forward losses. If you fail to do so, after 3 years you will not be able to amend your returns to correct the error, and you will lose the right to claim the losses. If you use a professional preparer, they should keep track of the losses year to year for you. If you decide to use a different preparer, make sure you provide them with a copy of your latest tax return as a reference. Even if you don't have any carry forward items, this is good advice if you are using a professional preparer for the first time or changing preparers. As always, there are many additional details to claiming capital losses that go beyond this oversimplification. Additional information and resources can be found in the video description. If you found this video informative, please give it a thumbs up and subscribe for more content. Please share this video with anyone who would find it useful. Your questions, comments, and suggestions are always welcome in the comment space below. Follow me on Twitter at TaxGeekUSA for announcements of new video releases and occasional tax tips and alerts. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.